Good afternoon, everyone, and welcome to the first Landbay Economics webinar of 2023. Last year we did slightly more than we anticipated. We normally try and do 3 a year. Last year with so much going on, I think we ended up doing 5 in the end as things were changing so drastically. And I'm delighted today to be joined by Dr. Andrew Sentance, CBE. Who until recently was a senior economic advisor at PricewaterhouseCoopers, and before that was a member of the Monetary Policy Committee between 2006 and 2011. So obviously during the financial crisis, which will come on and talk about his time there at some point. But what I'm going to do is the usual format. Andrew has got some slides to run through to give his views on where we are at the moment. And that's going to be for about 20-25 minutes. And then we may have some questions along the way. And then there'll be another sort of 20-25 minutes at the end for some questions as well. So please do, people have sent me some questions ahead, but please do enter Q&A in the box as you go along if there's something you particularly think on. And on that, I will pass over to Andrew. So over to you, Andrew.
Well, thanks very much. And good afternoon, everybody. And I'll sort of run through some slides summarising my views on where we're heading in terms of the UK economy, property markets, interest rates, inflation. Hopefully do that as within 20-25 minutes, and then we can have some questions. So we're going to have the first move to the next slide. So this is the order in which I want to cover things. First of all, to talk about the current surge in inflation. That is the dominant issue on economic policy at the moment, which is unusual because for most of the last 30 years or so, we haven't had to worry too much about inflation. And when we've had pickups in inflation, they've been quite short-lived, but this one is much bigger and is possibly going to be much more persistent. So we'll talk about that. Obviously, what happens on inflation feeds into what's likely to happen in terms of interest rates. And then that leads to what's going to happen to economic growth. And then I will talk about property prices and markets very briefly. I'm conscious that people on this call are perhaps a bit more expert on the property market, but I'll summarise what I think are the main implications, and then also move on to talk about the budget, which seems to be creeping up on us. It's only 2 weeks away now, and hopefully it'll be a more successful budget than the last one we had, which under Liz Truss and Kwasi Kwarteng. So we move to the next slide, which this summarises what current measures of UK inflation are telling us. And most people focus these days on the CPI inflation rate, which you can see is sort of just halfway down below the red bar. But if you look at various different measures of inflation in the UK, they're giving somewhat different pictures. All of them are elevated. So I could have put a bar that says the 2% inflation target. And even the lowest measures of inflation down at the bottom of CPI services or the services producer prices are 5.5% to 6%. But the big measures of the big increases in inflation are coming from the goods sector. So in terms of manufactured input prices, which obviously includes energy, commodity price increases, etc. And then that's reflected in the prices of goods coming out of factories, and they're running at about 14 to 15%. Then we have the old-fashioned RPI, which is being sort of not very much supported by the official statisticians, but it is quite widely used in the economy still. And then the component of goods in the CPI, which is running at about 13.5%, and then go down various different measures. Now, earlier versions of this slide, which I would have produced last year, would have had house prices towards the top, but the house price inflation has eased, and in fact, it's dropped below 10% now. Now, that's not a great reflection of control of inflation, because 10% is still 5 times the 2% inflation target. But house price inflation is easing. And then as we go down to the bottom, we've got various measures of services inflation, which are running at a lower level. So the big picture from this slide is obviously inflation is very elevated. The main measure, CPI, is still running at over 10%. But there's more inflation in the goods sector of the economy than in the good services sector of the economy. And we've got a sort of wide variety of different measures, which is perhaps not helpful when we're trying to get a grip on inflation. So if we move to the next slide, where's this inflation surge coming from? And the main point I'm making here is that the sort of public commentary focuses a lot on food and energy prices and the war in Ukraine, but that's not the only factor at work. Yes, it has contributed quite a bit to the volatility of inflation, but those of you who go and fill up your car with petrol will know that actually the petrol price has been coming down. When I was on the Monetary Policy Committee back in sort of late 2000s, early 2010s, I remember petrol prices got up to about £1.40 per litre, which is, you know, roughly where they are now. So we've moved away from the very extreme levels of petrol prices, and even energy prices are coming down more generally as the revision of the energy price cap by Ofgem has shown. But it's not all to do with that. So there's a whole range of other factors, supply chain disruption and material shortages coming out of the pandemic period. Quite an important factor is skill shortages in the labour market and the associated wage pressure that comes from that. In the private sector, wages are running around about 6-7%, and that's clearly not compatible with a 2% inflation target. And then there's various other issues to do with government policy. When we were going through the pandemic, the government made temporary tax cuts and provided support for business. As those have been withdrawn and phased out, that has meant that businesses' costs have been increasing. And also there's been a focus on raising taxes and business costs over the longer term, because the government has been concerned about public finances. Some of those have been reversed recently, like the national insurance increase, but that's still a factor in terms of rising inflation. And then there are two other underlying factors. We have a long period of loose monetary policy, of low interest rates and lots of quantitative easing. And throughout the period when we had this loose monetary policy, which started after the global financial crisis, many people, many economists said, well, eventually this may lead to higher inflation, but it didn't seem that way at the time. And it's taken a while for it to feed through, but that's certainly part of the mix in terms of what's contributing to current inflation. Then with higher short-term inflation, people's expectations of inflation in the future rises. And the point of the fact that we've got this very long list of factors contributing to inflation is that, you know, one or two of these things may move in a favourable direction, but we need more than one or two of them to move in a favourable direction to actually get on top of the current surge in inflation. So even if food and energy price inflation subsides, we've still got potentially tight labour markets. We've still got possibility of supply chain disruption, etc., and the impact of monetary policy and inflation expectations. So if we move on to the next slide, which basically shows the global picture, and this goes back to 2000. But even if it went back to the 1990, it went back early 1990s, went back. Oh, hold on, we didn't. Yeah. Then this spike in inflation that we can see on that blue line is much more significant and is likely to prove much more durable than anything we've seen for about 30 years. And just sort of observing about what has happened in terms of inflation over the last 30 years, or indeed in terms of the economy more generally. This is the first big inflationary cycle that we've seen since the early 1990s. And I think that's one of the reasons it's taken central banks by surprise. They thought they'd got inflation under control, and that if there was a spike in inflation, it would be quite short-lived, and they didn't need to do much about it, which was the case in the global financial crisis. But that's not the situation this time round, which is why interest rates have been rising. And interest rates could have risen much further, I think. The fact that they've gone up to 4% here in the UK and a little bit more in the US, a little bit less in Europe, but those are still sort of relatively normal levels of interest rates when you go back to the period before the global financial crisis. I think one of the questions that we'll face as we go through this year and into 2024 is whether that's going to be enough to actually get on top of this surge in inflation. And the red line is global GDP, and you can see that we've had two big dips through the global financial crisis and the pandemic. The pandemic was a very unusual episode. I can't remember a period in our economic history when there was a recession or such a severe downturn in the economy, which was driven almost purely by government economic policy. In other words, the government shut down the economy, and that's what created the big dip in GDP that you can see there, which we bounced back from. But that in itself has created some rather peculiar effects. Normally, if you had such a big fall in GDP driven by normal private sector activity, you would have seen much bigger rise in unemployment, probably a bigger fall in property prices, but that's not been the case because it's been this sort of artificially driven decline in the economy. But now that we've come out of that period, we're still in the global economy looking at fairly sub-average rates of growth. So you can see that red line tracking below the longer-term average for world economic growth since 1980, which is what the dotted green line is. So yes, we've returned to a period of growth, but it's growth which is below normal as we would normally experience it. So we go to the next slide, which says, which is about what's likely to happen to inflation. And this is, actually I haven't updated this to the latest Bank of England forecast, but it's not that different. But inflation is forecast to come down, but it's going to be still above the 2% target until effectively the second half of 2024. So we've still got another 18 months of above target inflation. So the pressures that have been created by high inflation, squeezing households, making the Bank of England's job rather uncomfortable, these pressures are going to continue for the next 18 months or so. Andrew Bailey, the governor of the Bank of England, said rather rashly that we've turned the corner on inflation, or something worse, some words to that effect. I think that's a very premature statement at the moment, and we'll have to see what happens. Yes, inflation has been coming down, but it's not yet below 10% in terms of the bank's headline measure that it targets.
Andrew, can I ask a quick question on this as we're
sure.
here? Because to me, it seems that because of sort of, I suppose, the reversal of some of the energy prices and commodity prices, getting, as that falls out, getting from, say, 10%, halving it from, say, 10% to 5%, seems, again, forgive my language, but relatively straightforward in some sense. But then, but actually then getting from 5 to, say, 2.5, that next half, that seems to be probably the bit that is a lot harder. Is that fair to say?
I think that's a very fair comment. So if we go back to the slide, we don't need to go actually back to the slide, but the one where I showed different measures of inflation, I think the most troubling ones, funny enough, are not the very high goods price inflation, which is reflecting those energy and food and commodity price pressures, but the services inflation, which is much more like pure domestic price inflation, and things like wage inflation, which in the private sector is still running at 6 to 7%. So if the sort of short-term world factors drop out, you're still stuck with a core inflation rate of somewhere around about 5%. And the challenge is probably going to be to get that down to around about 2%. So yes, with a lot of the temporary factors dropping out, the notion that we can get to 5% inflation by the end of this year, which is the government's target, though it's funny that the government has a separate target from the Bank of England, which has a 2% inflation target, is slightly worrying. But that should happen sort of fairly automatically. And then the question is, can we get down below that? So that's a good observation, yes. Shall we move on to the next slide, which is the consequence of this surge in inflation, which is, why is inflation such a bad thing? This is a question that I was asked a lot when I was on the Monetary Policy Committee. Many people say, well, why do we have a 2% inflation target? If the inflation was at 5%, wouldn't that be just as good? But the further you go up on the inflation scale, the more you get these sorts of effects. Obviously, with an inflation at 10%, that is much more noticeable. But effectively, consumer spending is squeezed, particularly spending on discretionary items. Inflation creates uncertainty about prices and costs, and that is a factor which can hold back business investment. Obviously, central banks need to respond to the sort of rise in inflation we've seen as they counter inflationary pressure. We've got higher pay demands coming along, and that raises the risk of, are we going to get into a wage price economic spiral? And then there's the impact on public finances, which is a bit of a two-way street, in the sense that what's called fiscal drag by economists boosts tax receipts. So higher inflation means that the prices of things are going up, so there's more VAT receipts. Wages going up, so there's more income tax receipts. But then we get the higher pressure on public spending, as we're seeing with these strikes in the public sector, which the government is trying to contain. So it creates an uncomfortable and probably depressing effect on the economy through various different channels. particularly through the channel of squeezing people's disposable income, which is obviously noticeable at the moment. And one of the surprising things that I think has happened is that we haven't seen a bigger negative impact on GDP and on economic activity from that squeeze. Because if you think inflation has gone over the course of the last 18 months or so from 0 to 2% to up to 10%, and the economy has not actually collapsed. It's just sort of ground to a halt. So if we go to the next slide, hopefully, So the question I think on many people's minds, particularly people dealing with the housing market, is what are going to be the knock-on consequences of this for interest rates? And the market expectation is that we're not far from the peak of interest rates. Maybe they've got a bit further to rise to around about 4.5% or so. That would be the central forecast. Now, while that's high relative to the 2010s, when I was on the MPC, that was sort of the normal rate of interest before the global financial crisis. And in one sense, that means that we're just returning to some sort of old normal level of interest rates. But the question is whether that is going to be sufficient to subdue the inflationary pressure, particularly in the labour market with wages rising. And then if that's not going to be sufficient, then interest rates could rise, not necessarily permanently, but to a higher level, say like 5 to 6% for a while. Again, that's not a shocking rate of interest in the sense we have had interest rates around about that level in the period when we've had the Monetary Policy Committee. We had interest rates, I think, just over 6%, around about 6 to 7% in the late 1990s. So we're not going back to the sort of world that we saw in the early 1990s or in the early 1980s when interest rates went up to double-digit levels. But that's the sort of range that we should expect for interest rates. So the central forecast being peaking somewhere between 4 and 5%, and then perhaps needing to go higher than that if things don't go well on the inflation front, but not going up double digit.
And on that, Andrew, and it's obviously most people in the UK don't have mortgages. Either their own houses outright, or in most cases they rent either in social housing or private rental sector. And obviously those that do have mortgages, again, the majority are fixed, and many for 5 years. So there'll be a large proportion of people who do have mortgages who won't see their mortgage rate change for 3 or 4 years. And so in that sense, how does that, so therefore it's a relatively small percentage, maybe 10, 15%, that have been, maybe impacted directly by particularly the larger increases that sort of have happened over the last 9 months or so. And likewise going forward, again, it's going to be 15, 20% or so that are actually going to feel it directly. So how impactful are interest rates? Does that mean because of that, do interest rates need to go even higher just to actually make an impact?
Well, I think the first thing to say is that interest rates don't just affect the economy through mortgage rates. So yes, that is one of the more important channels, but they affect all sorts of ways in which people act in the economy. They affect businesses. They affect people's ability to take out short-term loans, etc. But on the mortgage front, you're quite right that the impact is cushioned by people who take out longer-term mortgage deals. But the most popular longer-term deal is only a 2-year fix. So yes, there are some people who take out 5-year fixes, but that's a minority. But you're quite right that it's not, the whole of the UK population is not a big mortgage lender. So it is about a third who actually are buying their house with a mortgage, and then another probably nearly a third own their properties outright, and then just over a third, I think, probably getting on for 40%, are renting. So we have to be careful about generalising that the whole of the UK is just one big mortgage lender, mortgage borrower, which is sort of the impression created by the media, not necessarily by economic analysis. So we go to the next slide. This is the track of the UK economy over the period of the pandemic. There's big collapse in early 2010 when we had the first lockdown, which was probably unnecessarily severe. There were a lot of things that were shut down which probably didn't need to be shut down. And then it's gradually bounced back in various different phases. But if you look at the more recent progress of the UK economy, we're not sort of necessarily moving into any sort of deep recession or anything like that. But the economy is basically flatlined since late 2021. So for the last 12 to 15 months, the economy has been on a fairly flat track with sort of ups and downs, short term fluctuations around that sort of level, which is around about the level that we were before the pandemic. Now, you could say, well, we've got back to roughly the level we were before the pandemic. Isn't that a good thing? But we're normally used to getting sort of 1 to 2% growth a year. So over a 3-year period, which is sort of shown on this slide, you would have perhaps expected to see GDP going up 5% or so in normal times. And the fact that it's just come back to where it was before the pandemic is a sort of loss of what we would normally expect. So you can look at this chart in two ways. One is to say, well, it's not showing we're having a massive lurch into a recession, but and the economy is just flatlining, but also we've lost some economic growth along the way due to the pandemic. So go to the next slide, which compares what's happened over the 3 years, 2020 to 2022, for various different economies. And there's been a lot of debate about, is the UK doing better or worse than other economies? And the answer to that is we're roughly in the middle of the pack with other European economies. In other words, this sort of flatlining performance, if we compare on annual averages, has created a sort of very small annual rate of growth of 0.2, 0.3%. But we're not a startling outperformer, as sometimes government ministers claim, but we're not the worst, like Italy and Japan at the bottom. So we go to the next slide, which then shows what we're now expecting in the UK in terms of GDP compared with our two main sort of counterparts in the world economy, the United States and the Euro area. And we had a bigger dip than the US and the Euro area. Then we had a bigger recovery. But actually, looking at where we are now, we're expecting slightly weaker growth, or actually a decline in GDP in the UK this year, followed by some degree of bounce back in 2024. So relative to the US and the Euro area, we're not particularly well placed this year, but we should bounce back in 2024 to some extent. And if we go to the next slide, this is really just trying to put this in some sort of long-term context, that actually growth rates across the major industrialized economies like the UK have been pretty weak throughout the 21st century. So even the best performing economies on this chart, like Canada and the United States, are just growing at around about 2%. European economies are growing by, most of them, between 1 to 1.5%. Japan is growing more weakly than that, and you wouldn't want to be in Italy, that is not performing at all well and hasn't performed at all well for quite some time. The point of this slide is to say that we need to downscale our expectations about what economic growth can deliver, because even before the pandemic, we were seeing fairly disappointing economic growth across the G7 economies, our counterparts in the global economy. So go to the next chart. Why is that? Well, this just illustrates it in terms of the UK. Productivity growth in our economy has been weak throughout the 21st century at below 1%, whereas we're normally used to having 2% or above in the post-war period. And if we go to the next chart, it shows that the UK is not unusual among the G7 economies. In other words, there's a whole group of economies in that bunch in the middle, which has seen this rather disappointing productivity growth leading to disappointing economic growth. And across the major industrialized economies, the US is the star performer and Italy is the weakest performer, and then the rest of us are in a sort of similar pack, but not showing particularly strong underlying productivity growth, and that feeds through into the sort of economic growth that we can expect going forward. So, I mean, the point of this is to say that even if we bounce back from some of these temporary factors squeezing consumer spending, the inflation squeezing the growth in the economy, we shouldn't expect probably more than 1 to 1.5% economic growth overall, which would be disappointing in relation to the sort of rates of growth we got in the second half of the 20th century, which were around about more like 2.5%. So get to the next slide. Why has growth and productivity been so sluggish in the UK and its counterpart economies? Well, there's all sorts of theories about this, but nobody has a definitive explanation. You know, one view is that we had a big surge in globalization from the late 80s and the 90s onwards, which has come to an end, and therefore, without that surge, our economic growth is sort of flagging and weakening. We've had a series of major shocks to the economy: the global financial crisis, the pandemic, more recently these energy price shocks, war in Ukraine. Investment rates have been low across many economies. This period of ultra low interest rates may have blunted the drive in the private sector to raise productivity rates. We haven't had major waves of economic reform invigorating the economy such as we had in the 80s and 90s. Demographic trends and aging population may have played a part. Services-based activities generally have slower growth and slower productivity growth, so that may have also played a part. All of these factors may have only played a small part in the equation, but if you add them all up together, maybe that gives a more complete explanation of why we should expect weaker economic growth now than we experienced and expected before the global financial crisis. So moving on to the next slide, that just illustrates what I was saying about globalization. So this is a ratio of global trade to global GDP, world trade to world GDP. And you can see this big ramp up that occurred when the world economy opened up in the late 80s and 1990s and early 2000s with the growth of China and other emerging market economies. That sort of one-off spurt to global growth has come to an end, and that may be part of the equation about why we're expecting weaker growth going forward than we saw in that period. So go to the next slide. These are IMF forecasts for growth this year and the next 4 years. So what are we expecting in the next 5 years? Well, basically across the major industrialized economies, the range is mainly 1 to 1.5% growth. So Canada and the US are slightly doing better than that. Japan and Italy are doing slightly worse. But actually, this is not a very bright medium-term growth projection. And this is, again, a sort of consistent theme about what we can expect. Even we get through this temporary period of rather disappointing economic performance, we're not going to leap back to 2 to 3 to 4% growth. It's going to be more like 1 to 1.5%. So go to the next slide. What's all this mean for the property market? Well, this year we've had figures from the Nationwide this morning actually that showed that house prices are actually down year on year, which is quite unusual, but perhaps not that unexpected given what's been happening to interest rates. So there's a 3.7% decline on the peak. But that's really quite a small drop in the context of the fact that we've been seeing 10% house price rises, up until quite recently. There are some signs that property prices are now stabilizing as people's worst fears about inflation and interest rates are receding. And we're not yet technically in the UK in a recession, though we are expecting a mild fall in GDP this year of round about just under 1%, 0.8% on the current consensus. But even if we saw a 10 to 15% fall in property prices, that would just take the market back to where it was 1 or 2 years ago since we've been having 10% price inflation. So I personally don't think that's such a fearful outcome. Obviously, if prices fell by 30 to 50%, that would be a much more significant factor. And the structural problems in the UK housing market remain, which is supply struggles to keep up with demand. So that's an underlying factor which is helping to support house prices over the medium term. And that's mainly to do with issues with the planning system and the way that's operated.
On this, Andrew, can I ask a quick question, actually? And I know we'll have a chat later about your time on the MPC, but I was intrigued when you were there and from your knowledge of maybe other people who have subsequently served on the Monetary Policy Committee, how much weight does that committee pay to what's happening in the housing market? Because obviously, for most of the period over the last 15 years, other than the sort of 2 years, or 2 or 3 years in the middle of the financial crisis where they dropped quite sharply, house prices have been running away and rising, quite subsequently. Is it something that the Bank of England takes into consideration when they're setting interest rates, or is it's almost by the by?
Well, there was a time in the mid-2000s when the MPC spent a lot of time agonising about this was before the global financial crisis, agonising about the UK property market. Funnily enough, they were focusing on the wrong property market because it was actually the decline in the US property market, the collapse of the subprime market that created the global financial crisis. Obviously, it had knock-on effects for us, but it wasn't our property market that was the driver. It was the US property market that was the driver. I think the way the MPC actually look at the property market is, I think if you interviewed a sort of average member of the MPC, if you could identify such a person, they would say, well, it's not the property market per se that we worry about, but it's the knock-on impact on the economy more generally. So if you've got a very severe movement in the property market, either upwards or downwards, the worry would be either upwards, it's boosting spending too much in the economy and creating too much excessive optimism and too much of a perception of economic improvement, and that's potentially inflationary, or downwards, then it's has a knock-on effect of creating some recessionary pressures. But I think that the job of the MPC is to look at the broader economic impact of anything that happens, and therefore it's not the property market per se that they worry about, but it's the knock-on impact on spending and inflation in the whole economy. But I think if you said what would be the best outcome for the MPC, they would rather see a stable property market, i.e. very little growth in property prices, but nothing dramatic on the downside or nothing dramatic on the upside. So if we go to the next slide. So I'm just going to say a few words about the budget, and then we can have a more general discussion. So this slide is a sort of antidote to those people who are sort of worried and getting paranoid about the levels of government debt. So the UK is one of the economies or the countries that's issuing government debt for a long period of time. In our case, going back to just before 1700, when I think we started issuing large amounts of government debt to finance wars. And you can see that these spikes in the government debt to GDP ratio are associated with wars like the Napoleonic Wars, the First World War, Second World War. But the average over that period, and we haven't defaulted on our government debt, and we've managed it pretty well over this period for 300 years, is that government debt has been around 100% or just below of GDP. And that's sort of where it is now. So we're not in a government debt crisis in the sense that government debt as a percentage of our economy is at historically average levels. And also, of course, up until recently, we've had pretty low interest rates, which meant that financing government debt has been a lot easier and a lot less costly. Now, interest rates have moved up, but they haven't moved up to some sort of stratospherically high level. They've moved up to an average level, or they're moving up to an average level. So I think government debt is not the predominant issue for public finances. It's more the deficit and the fact that if we keep running high deficits, then it undermines the credibility of the government in terms of its ability to manage the economy. So what does all that mean for the budget, which is my final slide, I think, here, coming up? The public sector deficit is expected to come down quite quickly in 2023-24 from about 135 billion projected for this year to about 95 billion. Now, those sound like very big figures, but that's a fall from about 5.5% of GDP to about 3.5% of GDP. And in my view, a deficit of 2 to 3% of GDP is in the safety zone for public finances. In other words, we don't have to run a balanced budget, but we do have to keep the deficit at a manageable level. And the manageable level would be 2 to 3% of GDP. So actually next year, even without any action, substantive action in the budget, we're going to be quite close to that. And obviously as the economy bounces back in 2024, 2025, we should get back into the safety zone. So there's not a big crisis in public finances. But obviously there's not a lot of room for manoeuvre either. And this is when the politics comes into play, because the government's going to have an election next year, and they probably won't want to do very much in the budget this year because they would like to keep their powder dry for a pre-election giveaway budget of some sort in 2024. So for this budget, I think we should expect a few gimmicks and a few selective tax changes, but in the context of a broadly neutral budget. In other words, when March 15th comes around and we get the budget, don't hold your breath for when the red box is wheeled out at number 11 Downing Street. We're probably not going to see anything very radical happening. So that's my sort of summation of where we are now.
Fantastic. Thank you very much indeed. And I might just actually start. I don't know, I've spoken to you about this before. We spoke last week in terms of just briefly about, obviously you spent 5 years or so on the Monetary Policy Committee, and that coincided, with the financial crisis and effectively the beginning of that kind of virtually zero interest rate environment. So there's two bits to my question really. Is one, obviously the MPC, you get together for what, two days, I think it is, 48 hours, you get to see lots of information. Just how, if you could briefly describe that sort of process and whether you go in with a fixed mind of what you think you're going to do and whether actually you're surprised at where you end up, or do generally people end up where they think they do. And then also when, those interest rates were slashed sort of in round about 2007, 2000, when Lehman went, my assumption is, probably everyone on the committee thought this is something that might be the case for 9 months, 12 months, maybe a year and a half. In the end, it being 14 years. But when you look back now, I think actually those probably what was seen as temporary measures actually were, there for a decade and a half.
Yeah, I mean, I can't speak for all members of the MPC, and everybody's characteristics are different. I mean, I was a person who normally went into the MPC. I knew what I really was going to do or what I wanted to achieve. And part of my challenge was to try and persuade other members of the MPC in that direction. But it's the process as it was in those days was, and I think it's still basically the same, is that after a process of sort of more general discussion, as you say, there are a series of meetings that the MPC go through to reach its decision. And they take various forms, but the decision-making meeting, the governor, as the chairman of the committee, goes round the committee and asks people to say what they think. And you don't have to vote at that point, but most people do say what they're going to think. But it was quite clear when I was on the committee that some people were much more decisive than others. I put myself on the more decisive end of the spectrum. And I would have my sort of notes prepared, and I would, basically be keen to get my view across. But so that's the sort of general way people have approached things. And I think one of the good things about having a committee rather than just one person making a decision is you do get a diversity of opinion. And some people say, well, isn't it a bit confusing that different members of the MPC think different things and then vote in a different way? I actually think that's rather a strength of the process, because so there are times when everybody comes together and says, yes, it's obvious what we might do, and the global financial crisis was one of those episodes. But sometimes, if the economy is sort of in a sort of uncertain position, people interpret that uncertainty in different ways, and so you do get some diversity of view. I mean, when it came to the global financial crisis, I think that was the easy bit for the MPC, even though that sounds a bit facile to say that. But when the economy is going into deep dark hole, what do you do? Well, you try and stop it going any deeper than it needs to go. So cutting interest rates and trying to support the economy was the obvious thing to do. I think the difficult issues come for the MPC when the economy is recovering from that as it was from about 2010 onwards, deciding on whether we should start raising interest rates, when we should start raising interest rates, how much should we start raising interest rates. I was on the hawkish side of that spectrum when I was on the committee, but the arguments that I advanced didn't get that far, and we went through a long period where we didn't raise interest rates. And I think you'd have to interview various different members of the MPC separately and see what they thought. But I certainly didn't expect us to be keeping interest rates as low as they were for so long through the whole of the 2010s. And I saw it as a temporary thing to cut interest rates, to get the economy out of a deep, dark hole. And then when it's recovering from that deep, dark hole, to try and get back to some more normal monetary policy. But that argument really didn't win the day. It's interesting that it's taken a big surge in inflation to really prompt the MPC and other central banks to get interest rates back up to more normal levels. And you could argue that perhaps they should have done that a lot earlier.
Yeah, and you know, I know we touched on briefly, obviously the impact of the Ukraine war being obviously a major factor in sort of pushing inflation up to, particularly this time last year with the spike in energy prices. Obviously, that sort of from an economics point of view, that spike will soon drop out of the numbers. Obviously, the Ukraine war is still going on, obviously far longer than people expected, and obviously Ukraine is resisting far better. You know, people at the time thought Russia might be in 2 weeks or so, which obviously it's fantastic that that's not the case. But from an economics point of view now, is the Ukraine war significant now, or is it purely a political thing? Now that, you know, it's been normalised, you know, it's less in the papers than it was. But is it something that actually, you know, we from an economics point of view purely, that we've adapted to it? We know now energy prices have settled where they are, and actually it's purely a political matter now.
Yeah, I think it's, you know, there's obviously some longer term effect, but the sort of shock effect of it all has eased, in my opinion, and markets have started to adjust. And so, you know, when energy prices go up, the natural law of markets is that, first of all, it encourages consumers to conserve energy, and secondly, it encourages other producers to produce more energy, and therefore those processes have kicked in, and that's helped to stabilize the markets. It's also helped by the fact that certainly in Europe, we've had a relatively warm winter. We haven't had a very cold winter, and therefore on the demand side there hasn't been, you know, pressure from very cold temperatures for people to consume a lot more energy. So when we get into the summer, then, you know, those sort of winter type pressures are not going to be there. I think, you know, in the summer, I think we should see quite a bit of normality. There's more probably longer term effects maybe on the food side, because you know, Ukraine was a big food producer, and even though some efforts have been made to allow them to export more food price inflation is now the bigger issue for the UK and probably other countries than energy price inflation. So the food issue will be there perhaps for a bit longer, but yes, we are sort of adjusting to it. It's a bit like political and terrorist activity in the Middle East, which has been going on since the late 60s, early 70s. And, you know, there've been episodes when that's been a big issue and it flares up, and then it doesn't go away, but it's, you know, it's still there, but the economy adjusts and things start to get back to normal.
Well, we've got a few minutes. I've got one question that's come in, and then I've got one very quick one for me to wrap up on. I thought we'd got through it, and someone put a question about not a single mention of Brexit being a factor. And obviously, it seems from the slides that actually they're making the comment, this is their comment, not mine, that actually we seem to be, broadly speaking, in line with Germany and France, if you look at that, obviously. So in that sense, is Brexit a factor here? Obviously, we've seen the news lately around Northern Ireland, which is fantastic politically, but obviously Northern Ireland is only, 2% of the UK economy, so I assume the direct impact of that agreement is fairly minimal for the mainland or the whole of UK, while obviously it's impactful for Northern Ireland. But is there anything different for the UK because of Brexit, or the challenges that we faced, particularly around supply issues, are coming out of the pandemic, and the macro is far bigger than that?
Well, I think Brexit has had an influence on the economy, but quite a lot of that influence has been in the past, because the vote took place in 2016. And even though Brexit formally didn't happen until 2020, quite a few of the influences, for example, through the fall in the value of the pound, through increased investment uncertainty, came through in the late 2010s before the pandemic. So we did see some impact then. Most of the estimates, including ones that I was involved with when I was at PwC, suggested that the impact on the level of GDP in the UK of Brexit, the negative impact, would be around about 3 to 4%. But if you spread that over the period since 2016, which is a 7-year period, that's sort of knocking a small amount off growth, perhaps up to 0.5%, not a dramatic amount. Now, if you look at what happened in the UK before Brexit, we were definitely one of the better performing European economies. So the fact that we've moved back down to performing roughly the same as Germany and France in terms of economic growth is actually disappointing in terms of our previous performance. So we probably lost over a number of years something like 0.3 to 0.5% growth per annum, but it's not been a disaster. It hasn't created a massive recession or anything like that. I think the problems that are caused by Brexit are more in the microeconomy, in terms of the difficulty of doing things, in terms of export and import, and also access to labour markets, because we don't have such good access to labour from the rest of Europe as we did before Brexit.
Very, very quickly, last one from me before we wrap up, and I'm going to put you on the spot. Obviously, the market thinks interest rates maybe another 0.25% over the course of the year, and then maybe slow down and normalise at 3.5% or so. The two very quick questions: A, where do you think they'd go? Do you think that's right, what the market thinks? And B, if you want the MPC, is that what you'll be voting for, if that makes sense?
Yeah, I would have a sort of slight bias to be prepared to raise interest rates more than that, but very much be driven by what's happening on the inflation front. And I think that's going to be the driving factor for, the MPC as a whole. In other words, if what Andrew Bailey has said is correct, we've passed the turning point, interest rate, inflation keeps coming down. I think that scenario is a reasonable scenario. But if we find that we get further upward pressures on inflation, and then the Bank of England needs to do more, that's when we move into a scenario where interest rates need to go higher. But I've suggested that level is more like 5 to 6%, not like 8 to 10%. In other words, there's a limit in terms of how far you can push up interest rates in a short space of time, particularly given where we were coming from, where they were virtually zero for over a decade. So we've already moved a long way away from that. And I think that will weigh against having much more dramatic increases. But I would put the range of being, yes, 4.5%, I think it's quite likely. But the notion that the MPC or other central banks will actually start bringing interest rates down back to where they were before is also mistaken. I think they'll be quite happy and think it's quite right to keep them round about that level if we get to that level of, 4.5%.
Well, thank you very much for that, Andrew. So the summary is, I suppose on that front, so likely to be higher in inverted commas. I know not higher historically for maybe longer than we think. But first of all, thank you for everyone for joining us, but particularly really appreciate, Andrew, you joining us and spending an hour with us and putting yourself away from the cricket. And we haven't even mentioned Mark Carney. Amazing, we got through an hour with that. But thank you very much indeed, everyone, for joining us. And once again, thank you, Andrew.
Right, my pleasure.
Thanks a lot.